Hey, what's going on, guys? Welcome back to the Real Estate Playbook. My name's Andrew, and today we're going to talk about how you can use mortgage insurance as a tactic to dominate in your finances. So let's jump right into it. And just for starters, guys, mortgage insurance is something that you have to pay that's a part of your monthly payment if you are putting less than a 20% equity stake in your home. So yes, this is something that you would have to pay for in addition to your property taxes, your homeowner's insurance, and your principal and interest payment. But this is going to change based off of person to person. And really, there's four main factors that affect your mortgage insurance, which are your credit score, your debt to income ratio, your loan to value, and then ultimately the specific loan program you're using. But in some cases, this can be a very small expense that can have other big upsides on the other end. So today, I'm going to break down some of those upsides of still having that payment so that you can accomplish other things in your finances. Number one, a big reason why you would have mortgage insurance is simply if you don't have that 20% down payment from the get-go. A lot of times people assume that you have to have a 20% down payment to even be in the conversation to buy a home. And that's just not the case. You can put as little as 0% down depending on that specific loan program. But ultimately, if you don't have 20% down, you can use mortgage insurance to get into a home faster. And that way you can start that investment class in real estate and start earning the equity and the appreciation on your home rather than having to wait until you do have 20% saved up. Another reason why you might put less than a 20% down payment on a home is because sometimes when you put a lower down payment, you have a higher loan to value, you can get access to different loan programs that are going to have more advantageous interest rates for you. So what you can do is you can originate the loan with a lower down payment, get yourself the premium pricing, and then after that loan is completed and funded, you can go back and use that money that you already have saved for that 20% down payment. You can make a large principal reduction towards the loan and basically recast your loan, wipe out the mortgage insurance, and then now you don't have mortgage insurance and you got a much better interest rate because you tactically went through that process. Another big reason why you might want to consider mortgage insurance is because sometimes when you're saving for a home, that 20% that you do have saved up, or even if it's a little bit higher, that may be all you have. And the last thing you want to do as a buyer is completely drain your emergency fund, right? So we still need to have an emergency fund set aside just for when life happens, right? Things can go bad and things will go bad. So we don't want to have all of our money just stuck in the house and then be left vulnerable in a different situation of our finances where we don't have money to pay for a car that broke down, or if we lose a job, or if our children get sick, or if the unexpected happens, we need to be prepared. So, having that, in some cases, small monthly payment at least gives you the money to have that emergency fund still available, because we do not want to just run ourselves dry and not have that. Another big reason why homeowners, especially where I'm at in Utah, choose to put a less than 20% down payment is because a lot of the people that are buying homes these days, they're doing a lot of add-on improvements, or they're buying, new construction that may not have a finished basement. So a lot of the clients that I'm working with, they're going to be doing these remodels and they're going to be doing these home improvements. So they need to have some cash available to do those projects. So instead of having, again, that money stuck into the home, they can have it liquid to, change the flooring plan, or change the actual paint color, or finish the basement, or change the light fixtures or the windows, or whatever needs to be done. There's money that can be used and it's already been allocated for those home improvements to be taken care of. And then also started earning that additional appreciation for the improvements that you've made on your home. Another reason why some clients choose to have mortgage insurance is because they do not want to liquidate the investment classes they have, especially when it comes to retirement investing. So your 401ks, your IRAs, if you have all this money that you've been saving, chipping away with your employer or independently, you don't want to take that money out of your retirement that's set there specifically for retirement and take it out of the market and put it into your home. So even though you may have 20% to put towards your home, if you were to withdraw money from your retirement accounts, it may be an option to consider just leaving that into your retirement accounts. So that way you're not running that bone dry either. A lot of times clients also choose to use mortgage insurance because they may have other high interest debt that they need to pay off outside of their home. So even though they may have money to put towards a 20% down payment, they may want to use that cash to pay off the car, pay off the student loans, pay off any credit card debt if applicable. So instead of, again, having that money stuck liquid, we can just wipe away that debt. So that way, on your own personal balance sheet, we are lowering the liabilities and ultimately lowering the cash flow that's leaving you and your family's bank account every single month by paying off that debt instead of just putting it in a home. So we can accomplish it that way by ultimately just lowering your overall expenses. And lastly, I wanted to give you one more tip that you can use to leverage mortgage insurance. And this comes into play when you're doing something called house hacking, which is an investment strategy when essentially you buy a home as a primary residence, and then you're living there, and then you move into a new primary residence, you rent out that previous primary residence, and then you continue to do that process, and then basically you're renting out those homes that are in arrear. And what this allows you to do is when you move into that new primary residence, you can put a small down payment on that home and start the investment property in real estate. So you do not have to have the traditional 25 or 30% when it comes to investing in a piece of real estate that's strictly for investment. You can get into the investment market for real estate at a much lower entry cost because you can take advantage of the primary residence underwriting and essentially use mortgage insurance to grow your real estate portfolio through the house hacking system. So that's just an additional tip that you can use if you're in the investing stage of your life and you're creating your real estate portfolio, and you may not have the cash to just throw at investment properties and those type of deals. So there you have it, guys. Those are several tactics that you can use when implementing mortgage insurance to dominate in your finances. And now again, mortgage insurance is going to change depending on person to person, but depending on your situation, this could be a very low monthly cost. And as we mentioned, there's a lot of different benefits that you can take advantage by simply incurring that if it's the right situation for you. So everybody's situation is a little bit different, but this is something I would consider if you have some of those situations that I mentioned. So that way you can use this tool to leverage in your own personal finances. So thank you guys for watching. I appreciate you staying with me all the way to the end here. And if you have any friends or family who are currently going through the home buying journey or are going to be going through the home buying journey here in the near future, feel free to share this content with them. Really, the whole goal of the Real Estate Playbook is just to provide free knowledge for home buyers and homeowners as they've been going throughout the process, or if maybe want a refresher on the home buying process so that they can go out there and win in their finances. So thank you guys. I appreciate you watching, and I'll see you next time.